takes a family office to raise a startup child.
I'm going to completely make up this intro, but it sounds good to me. For any of those who actually have children, you know how important family support is. And so I make it up and say it takes a family to raise a child, and probably many of you agree with me, but also to build a company and also to have really interesting style investors to help it along the way. It takes a family office to help raise a MedTech startup child, and that's what we're going to be talking about today. I call it the enigma because I hear so many entrepreneurs talk about, how do I find family offices? Where do they come from? What do they invest in? How different are they, or how similar are they to a venture capital firm? What is the nuances? We're about to demystify that right now with these incredible gentlemen up here, all coming from various different backgrounds. Actually, 2 from the United States we'll get into, 1 from Spain, 1 from Israel. Thank you so much again for making it in. I know it wasn't an easy situation, but thank you so much for joining us, Dan. We're going to get into everyone's background. But give a round of applause for the family office members who have made it here today, so hopefully we can learn something fun right now. Give a round of applause. Okay, we're gonna have some fun, starting with some introductions and diving into some questions. Dan, you have a very interesting background, so talk about this long-winded background that you have that led up to you jumping into a family office, what you do, and then what you're doing now.
So I got to a family office. I was a founder of a company, and one of my investors, when we eventually sold the business, one of my investors came to me and said, listen, you've cost me a lot of tuition, so now you're going to have to pay that off and you're going to come and work for me. And that's something you can't argue with, but someone wants you to come and manage their family office, which is how I ended up doing it. And of course, I have a view. I did that family office for 12 years. And subsequently, I did something else, which was also in the family, established an accelerator in another family office. So I've been doing this a couple of times. I've also started companies. My accelerator activity has been about establishing companies together with founders, sort of working shoulder to shoulder. So that's in a nutshell.
And does your experience exist in Europe, United States? Where are you coming from?
So we worked out of Israel in all of these. We did investments in the US as well, and much less in Europe. I don't want to get into it, but the US was the natural place to do.
Very good. Please, Pablo.
Not too dissimilar, I would say. So I started, however, in corporate pharma, then became a founder like yourself. The chairman of my board was a member of a family, and a couple of startups later asked me to run his family office fund in healthcare. And I've been doing that for 2 years. The companies that I've worked for have been global, mostly US based, not that much Europe. However, the family made its wealth in healthcare in Europe mostly. So we invest in both sides of the ocean.
Please.
Yeah, so a little bit different structure and background. So Broadview is a investor on behalf of a charitable family trust. And so we have a team of people in Boston focused on cardiovascular disease and stroke, which is the mission of the family trust. And I came to Broadview by a background in cardiovascular research and then some time on the business side of our industry and consulting and banking.
Thank you. Stephen, tell us about yourself. Where you're based, what you do. You got an interesting story. I love your story. I love all these stories, but tell us about how Unorthodox came to be.
Sure. Well, my personal story is not the fun part of it, but by way of background, I was an investment banker for many years, based in New York, and I knew our founder through those travels in that business. Our founder had been a serial entrepreneur, not in the healthcare space, and had a company that made very large commercial ceiling fans, up to 25 foot or 8 1/4, 8.5 diameter fans. The name of that company was called Big Ass Fans, so great name that people remember. Unorthodox Ventures, not quite as good a name, but I kind of take the credit for the Unorthodox Ventures name, so not as good as the founders, but it is what it is. We came to, when he sold his company, he really wanted to work with entrepreneurs and help them build their businesses, and the premise was not just to provide capital, but tactical operational support. He lifted out a group of folks who worked for him, all people with real operating roles, and the idea was that they would provide that expertise on project basis. We don't, we just do that as a value-added investor. We're not looking to be consultants and to help companies. And so that's what we do. We ultimately came to the MedTech. It's a longer story I won't get into here, but we spend about 80% of our time focused on medical devices, more recently including digital technologies, digital health solutions. And that's what we do. I'm personally based in New York. The firm's based in Austin, Texas. We have a couple guys on the ground in Israel, and from a regional perspective, we look at opportunity sets in North America, Europe, and Israel.
Thank you. And we'll get into some more tactical questions, but some of these more fuzzy questions, these entrepreneurs, they run around, and it's very easy to find a list of medical device VCs if they really want to find that. But they hear this notion of family offices, and then there's like these stereotypes of, okay, they're rich people, but how do you find them? And then there's some advice that says, okay, go to cocktail parties. If you get one, you get them all. How do entrepreneurs find family offices? Like, what is the best way of approaching a family office? And is it really silent money and really hard to navigate, and you have to get through a secret door in order to get one of them? How does it work? Pablo.
I don't think we're secretive or shy. We're all here on a panel standing where everybody can approach us. And we're in the business of deploying capital, and so not too different to funds. I think we just have mandates that may be a little bit more, at least in my opinion, in my case, wiggly, in that we have more wiggle room, we can be more dynamic. At the same time, we can invest for longer periods than regular funds. Because the LP structure is fundamentally different, and so is the decision making, and in many ways, so is the due diligence that we do on companies and founders. A little bit, I think this speaks about the story of Dan and myself, where we were previously founders and entrepreneurs, and we got hired by family. This is the kind of relationship that you establish. It's not so much a transactional relationship with companies, but rather a personal relationship with companies, and so I would like to say that we share that operational view, and that's a common theme that I've seen across family offices. But then again, it's a very diverse group of people and investors.
Dan, what do you have to say about that, especially being Israeli-based?
So I think in Israel, and when you look at the ecosystem, a lot of the family offices is actually second-generation high-tech successes. So it's people who have exited successfully in the tech sector. So you can actually understand that if someone has made $100, $200 million on an exit, they have a family office because they have people managing their money. So whether it's a formal structure that has actually VCs on board, or if they just have the willingness to invest, you should look up these people, especially if they're in your space. They can come in with so much more than just the money, some understanding of how you build a business, right? So every time I have something in consumer goods, I'm first thing after Steven, because these guys have more consumer experience than anyone else and have made a lot of money. So this is one thing you have to remember, that when you go to a family office, you're not just looking for money. So a VC will have picked up money from institutional investors, whether it's insurance companies or pension funds or anyone. In a family office, you have people who have actually made money from building businesses, not from selling businesses in many cases. It's actually building sustainable businesses, successful businesses. Maybe they exit them, and maybe they didn't. Maybe they're just drawing out a lot of money. So these are business people, and you should, when you look for it, you should just look for people who have invested in your space. Try to look at the names, even if it doesn't say VC or it doesn't say partners. It could be a serious investor, and so be open-minded about it. And I think always the best way to find people to invest in you is to look at who has invested in people in your in proximity of your business, and then try to approach those. That's how I would go about doing that.
And David, you represent Broadview Ventures. It's a unique bird, because I heard Broadview Ventures for years, and maybe it's my own fault for not digging in too deeply, but I always thought you guys were venture, and came to find out that you're representing a family office, like you were mentioning, or a charitable trust. But you act very unique, because talk about some of your KPIs that you're focused on, how you actually invest, because it's somewhat of a romantic story, especially to an entrepreneur's ears, where you're not there throwing away money, but you are very mission focused. And how does that correlate necessarily to your expectations on ROI?
Sure, yeah, it's a great question. So the LeDukes who established the LeDuc Charitable Trust that eventually became the owner and funder of Broadview, they had a family history of cardiovascular disease. And so when they sold their businesses and established their trust, the mission of the trust is to improve patient care and patient outcomes in cardiovascular disease and stroke. And so as a family office at the higher level, of course, they have investments and interests in other things, but Broadview is really the mission arm of what the trust does. So we think of what we refer to as a double bottom line, that first and foremost, the goal of Broadview is return on mission. So how many technologies are advancing into and through clinical trials? You know, are we helping companies to raise follow-on capital? And ultimately, how many patients are being treated with the technologies funded through Broadview Ventures? That's number one. And then, of course, if our investments also return capital to the trust, that's great. It's just, for us, uniquely not our primary objective.
Yeah, I was just going to make a comment. I think when you think about traditional VC firms, at the end of the day, all they really care about is return on capital to their investors. And by the way, that's good. That's all they should care. They actually have a fiduciary responsibility to do that. I think, I think of ourselves as the least mission-oriented group in the world, because we, a lot of the classic missions, and very respectful of the Broadview folks, and we co-invest with them and alongside them in a lot of situations, but we don't have a mission of trying to save the world. On the margin, though, and our founder, if he can invest in two companies, one where, we make the same return, but one where there's a couple folks involved and they do something and they sell it for a lot of money, or we create a lot of jobs out of it, he would bias towards creating a lot of jobs. So we have a tiny piece element of mission, but we really, quite frankly, operate, I would say, like an institutional, classic institutional venture firm, with one difference, and again, Pablo alluded to this, which is our time horizon is much more flexible than most folks. So when you say, where I'm going with all this is the scope of family office is much broader, I think, than traditional venture firms. And while they like to talk about their culture and differentiations, it really is mostly money and return. On the margin, maybe where they can add value. Whereas within the family office world, you'll see everything from people where returns are secondary, or returns are first, or they're helping, or whatever it is, and it's just a different dynamic in terms of the outlook. And again, on this margin for us, our founder, his real intent when he set up the firm was he wanted to be part of building great businesses. So again, our return is really important, but it's a derivative of building the great business. And on the margin, it probably affects how we think and how we analyze, although I think to the outside world, it probably looks like a traditional exercise.
Can I add something to that? I want to pick up a little bit about that, because when I started at Orem Ventures, we had a lot of venture philanthropy investments. And these were the kind of, we had done a venture investment, a conventional term sheet. We were always lead investors. We invested $5 to $10 million. And then we were stuck with these companies that had a very good mission, but could absolutely not raise money, because even from the beginning, we knew it was not going to make money, right? So if you're trying to make a hybrid rice species, there's no money in rice. It may be the primary carbohydrate in the world, but it's something the UN throws at people from airplanes, and there's just no money in it. So comes round A and comes round B, and no one wants to join you because someone has to join the mission and not the ROI of it. So what we did was we split the two into a very significant philanthropic operation that was completely philanthropic, and then we behaved VC-like in the VC investments because we wanted co-investors. We wanted the companies to become successful. And that's why we found it was very hard to be philanthropic. That being said, we were very sensitive about the issues we dealt with. So if the principal didn't think the issue was interesting, we just wouldn't do it. Right, so there are interesting issues, saving people, healing cancer, saving everyone who has heart failure, and then there were all the issues we just didn't want to deal with. So there is some on the mission there, but at the end of the day, we found that being a family office and being successful, we needed to make investments that were not very different from what a VC would do because we needed them as partners.
In also, complementing what you're saying, I mean, a lot of companies that approach us, or founders or entrepreneurs, forget that a family office really is a structure to increase, at the very least, generational wealth. And it does so through all possible financial asset classes, whether it's real estate, public equities, private debt, you name it. And venture, which I think is represented here on this table, is only a fraction of that, and not unlike any other, asset manager, it's not the majority. And so we go through ups and downs in allocations, depending on whether we're evergreen or not. We go ups and downs in terms of the market because we don't invest in a vacuum. But most importantly, I think, even if we have longer investment terms in general, or exceptionally longer, we're not like an endless pocket of money. And I think a lot of people forget that. When you say there's super wealthy individuals or structures, yes, but our allocation is not infinite, and we need to produce return on investment.
Yeah, and to Dan's point, we are mission first. That is what we do. But at the same time, we need to be practical and intelligent with how we deploy that capital. We can't waste money. That would be irresponsible to the mission. And so sometimes it's an important point to try and tease out to entrepreneurs and other people in the ecosystem that we can't fund things from a cardiovascular device from seed through approval that can be $100 million, and that's way more than we can support on our own. So we need to be investing alongside other more traditional venture investors or family offices. And so we still have to think about commercially viable products. We have to think about business models. We have to think about appropriate valuations. And so even though we are mission first for Broadview, we are still having to act in this ecosystem of financial sustainability. So we can't ever just let that to the side. And so that's something we have to remind people sometimes as well.
But the flip side of that dynamic, and I think we've all talked about this, is that I think somewhat uniquely the medical device, maybe more broadly MedTech world, by nature of those things, is a very collaborative environment. So we all talk here. Pablo, I didn't know before, but we will talk, because we've talked now. We will talk in the future, and with Dan and David, we talk and share ideas and share opportunity sets. We don't see ourselves as competitors, and so I actually think it creates a better dynamic. If you are kind of this family office structure, I think it's actually a better dynamic for us culturally. Even though I would argue we're pretty tough guys at UV and very business oriented about it, the underlying dynamic in kind of, call it, our industry sector, it creates a little bit more flexibility of room for how we operate culturally broadly as a group.
A few questions, smaller questions that kind of fill in a bigger picture, but because they're not necessarily defined rules or a thesis for, say, like a true venture capital or an institutional venture capital firm, is it possible for family offices to make emotional decisions because they simply like the company?
Depends on the family office, and for sure the answer is it possible? For sure the answer is yes, and we think of ourselves as analytical, but I could tell you our founder can sometimes be emotional, and at the end of the day, it's his he's involved in, it's a little bit, again, our situation may be a little different. He's involved in the business, he's involved in the investment decisions. He hasn't outsourced that just to pure, money managers. And so he sometimes sees things that he really thinks are interesting, and he likes. And so the quick answer is, of course, yes, it happens.
Yeah, I would say that in a family office you have, different routes for investing, and if it's not through CG Health Ventures, but the family member who's backing us wants to back it up, they will be backing.
I'll return the question to you. Do you have to keep your boss happy? I'll answer myself. Yes, you have to keep your boss happy always. So it really comes down to, this is not an investment committee, at least not the way I've been working. This has been Krav Maga. This is like, we go in it together, right? And you look at the eyes, the white of the eyes of the LP, So if you're a venture capitalist and you have this fund and you invite at the annual meeting, it's going to be at the Four Seasons at Carlsbad, everyone's going to be playing golf and everything, and see that you don't know golf for shit. And then you give these reports and overly optimistic things, but this is not how family office works. This is not, you don't go to Carlsbad. You sit in the office, you look each other in the eyes, and you have to say what's going on with the companies. So from that point of view, yes, there are emotional decisions. And I could easily see myself do an investment that maybe I didn't believe in 100%, but the principal wanted to do it, right? So you have a grandson with type 1 diabetes. Do you think I'm not going to invest in it if principal wants to do it? And I'm not saying that we did, but this is the thought of, we actually once we had a type 1 diabetes, we had not done it emotional, and someone came and said, yeah, my grandchild had type 1 diabetes, put down $5 million. And was a terrible investor because they expected us to solve the problem for the grandchild, and medical devices don't work like that. This was an artificial pancreas. We all know that's 10 years at least. So it's actually the kind, you have to be careful when you're a founder not to find these very emotional investors, because you may not want to deal with them downstream when you're going to be against, and things are not going like you wanted, and suddenly the timelines are going to extend it, and they were actually thinking that you were going to save the life of someone. So I'm not even sure that for founders that's the best situation to get yourself into.
But by the way, there's emotional decisions made in all sorts of firms. The only, probably in a quant hedge fund, might be the only place where it's de minimis or doesn't exist. I mean, but you can go into private equity. I mean, traditional LP private equity, and then some founder made money or lost money on a type of investment, and gosh, the next thing comes along and they're ready to do the same thing because, well, I made money on it here. I'll make and that, it's semi-analytical, but that's largely emotional. So emotions drive into all of these processes. The question is the degree. And to Dan's point, you'll have somebody who, in our case, we see it all the time, where just for whatever reason it catches, there's a little glow, there's a little silvery, reflection off of something, and people get excited about it.
So it's a hard line to walk between the ROI and the philanthropy, but when you think about an entrepreneur running around, they have an interest that they need to satiate. They need to raise their fund. Not to say that they don't care where the money comes from, but they're hitting everyone that they possibly can that would give them attention, and then assess if there's any interest later on. But what they don't really understand is that lineage, or what comes behind the story of that family office sometimes. What I mean by the difference between philanthropy and ROI, and we've touched on it some, are these ultra wealthy families that, when we know health tech, MedTech is a very hard industry to invest in, and it's very patient capital, or it should be patient capital. Are these families already taking care of their real estate portfolio, their publicly traded portfolio, their investments in all these other sectors that are more inclined to generate revenue either on a quicker basis or more on a guaranteed basis? And then there's this little sliver left that they invest in healthcare and life sciences, just kind of out of that emotional philanthropic feel?
Yeah, I mean, as a VC, you're as the family, part of the family office that does the innovative investments. You're part of a resource allocation. It's probably a very small part, right? So you have the real estate, you have the markets, you have the private equity, and then you have this small part. But you have to remember that the innovative part of that portfolio, all of these things are boring, right? We all agree. Real estate is boring. All of the other things are boring. Innovation is the good story, right? This is the bragging. This is the story you're going to tell at dinner. I just invested in this company. And that matters, right? Because there are certain things you don't want to talk about. You may not want to invest in proctology because that doesn't make good dinner talk. And then you become scooted against these things. It could be the best business in the world, but sort of this is people who want to share what they're doing in their daily life, and actually running a portfolio may not be so exciting, especially when rates started to go up. Suddenly you put $1 million in the bank in Switzerland, you get 7%. Who's going to invest in innovation? And then what are you going to talk to people about? Yeah, I just deposited money in Switzerland. It was really exciting. So then you become the part that is the exciting part of it. You become the story of the portfolio. And then you, as the one who manages this, you have to manage the story. You have to generate a narrative that's going to be interesting and making good talk. And it's an opportunity because it means you can go to the real innovative stuff.
Yeah, I mean, Broadview, I think, is the most extreme example of this, where we are a fully separate entity to do the thing that the family cared about. We do the mission investments as a separate legal and operational vehicle from the rest of the holdings and interests of the trust. I mean, we are somewhat connected. We're all a part of the LeDuc Trust, but I have quite literally no insight into the other holdings or investments that the trust makes, and that's not my job. That's not what I'm hired to do. And so everything we do is that passion project, and it's something that the directors of the trust really care about, and because this is carrying on the legacy of the LeDuc family. So yeah, very much true.
Well, Dan, as guys who are invested in a constipation solution, I'm not sure how we fit into your proctological discussion, but I will say living up to our name of unorthodox, we have a quite different approach in terms of what we think is exciting to talk about at the cocktail parties. Now, how many of you want to have drinks with me after that, I'm not sure, but we have a different take.
Well, part of that,
Fun at parties.
so part of that I agree, and part of that I don't. I mean, I'm going to explain why. So the family that is back in the vehicle that I manage owns a partially publicly traded company. And so journalists are constantly in the hunt for stories, whatever they can make off. And I can assure you, proctology or constipation will make a good story. And along with a list of others, to have a story on media about such and such invested in such and such. And that's part of the reason why I think some family offices, not all of them, are more discreet. Like, we're not open about our portfolio, for instance, or our investment criteria. And part of this is because sometimes we see a lot of great innovation in areas which may still not be completely consolidated as conditions. I mean, I'm thinking about, female sexual dysfunction and things like that, right? Which are, if you go by the book, they may or may not be established conditions. They may be good places to invest money. They may be interesting technologies. But if you make an investment and a journalist picks up on this, then all of a sudden, you're in a snafu where you didn't want anything but investing in exciting technology.
So we just finished up an excellent panel talking about health system investment arms, the analogous example of how they could be like a corporate venture capital firm. We talked about other styles of investors that have a value add. So the health system investment arms talked about how they champion their clinicians beyond the check that they write. Others, when it comes to institutional venture capital, they talk about the network that they bring. But when you talk about representing a family office and they have all these different asset classes that they invest in, not just singularly, they happen to invest in MedTech, but they invest in other things. Besides the check, our family offices saying, wow, interesting, I'll do the diligence, or I'll follow the other family offices or the other investors trusting their diligence. Sounds really cool. I'll do what I need to write the check and then wish you guys luck? Or what resources do family offices provide?
I mean, we act, again, as a traditional institutional VC firm. We always, we will, lead deals, we'll co-lead deals, we follow, but even when we're following, we always do our own primary diligence. Now, if there's folks that we know and respect, so let's say David's looking at a deal and they're leading a deal, and, we'll ask them, will you guys share your diligence materials? And I don't think there's anything unique being a family office, and again, the way we do this, but we'll leverage off that, but I don't think, again, no different how we would operate, whether our money's coming from, single source or if we had LPs in it. So that's the way we operate with all this stuff. And I'm sorry, I just want to touch on one interesting thing, though, that you mentioned when you talk about corporate VCs, health system folks, and folks like ourselves. One thing, because it is such a collaborative environment, and you pretty much always have syndicates, it is important, and it's part of our diligence thinking of what is motivating the other folks. And so we have a lot of respect for some of the, particularly you call it the health system innovation centers. We're trying to spend a lot more time because they're so smart. They have incredible resources. Dave and I were just talking about some of these issues specifically. But their motivation is a little bit different. And if they're a classic VC, their motivation is a little different. And if they're a corporate VC, they're motivated. So as investors, we think a lot about what's motivating those other people. And to the extent that they're directly aligned with us, we say, great, we have a lot more faith, and put your money where your mouth is, and we can believe it. To the extent that what they're after is a little bit different, that goes into the calculus of, okay, We like it 99%, we like it 98%, we like it 82%, or whatever it is. And so that is an interesting element, I think, for us as investors in this space, given the nature of what the syndicates look like.
Yeah, for us, we're so deeply focused in one area, in cardiovascular disease and stroke, and specifically the mission of how a technology is going to improve patient care and patient outcomes, that our diligence is very, I would say, very deep in science, clinical, technical of do we think this technology can work? Which patients is it going to treat? How is it going to help? How does it compare to standard of care? Most of our diligence is really focused on that, on the scientific and clinical side. It's not that we ignore things like business models and valuations, but it's secondary for us. So I think that's where we spend a lot of our time in diligence, and then I think because of that and because we're so narrowly focused that when we go out to lead a deal, because I would say we lead or co-lead half to 2/3 of our deals, I think when we go to syndicate things and we call our investor friends and we say, hey, Steve, we're working on this, I like to think that Steve realizes, okay, well, Broadview probably did some work here in cardiovascular disease, so hopefully they know something about what they're talking about.
It depends on who at Broadview.
That's true. The royal we here. And that's, I think, important for us. And then also to the point of how we like to be involved, it's not just, that we will be involved, it's something that we select for, that we don't see ourselves as a good fit in a deal if it comes to us and they're raising $30 million and they have 28 million syndicated and they just want a final check to sit on the sideline and watch and wait. We're almost always going to say no to that deal because we want companies where we can be active and helpful and connect to our clinical network and connect with our advisory board and be really involved because we see that as part of the mission for us.
So maybe at Orem Ventures, we were very well connected, so we had a very good network, significant philanthropic activity, and significant economic activity. But what you really got was access. We had the flexibility, for example. I could say, I'm going to hold back on deal flow now. I'm going to work with this company for half a year, and that's the only thing I'm going to do to build this business. And then when I started T-Side, I was trying to mentor companies, and I saw no one could pay me for it. So it's a terrible model to give away for free. And then I thought about a worse model, and that is, how about I pay people for me to mentor them? And we called it an accelerator because it sounds better. But essentially what that was is, let me invest $250,000 in your business, and let me work with you for half a year. I'm paying for myself. And this is something very important. You're talking about people who have business experience. You can get access to them. I had the prerogative in both these roles. I didn't have to raise my next fund. Most venture capitalists are busy raising their next fund. And I'm just saying this as criticism. It's just how it is. And I had much more time available for deal flow. I had much more time available for my portfolio companies, especially for the younger children that they needed more attention, those who maybe had some behavioral problems that we needed to work through. And then I had the prerogative to say, okay, this is what I'm going to be doing now. I'm not going to let this one go south. I'm going to work with this one until we turn it around.
I roughly agree with everything that was said, but I'm going to paint a slightly different color to this because I'm based in Spain, in Europe, but most of my investments are in the US. And so due diligence in the US is very different. Exposure to liabilities in the US is very different. So most of the times, and we're a small team, I cannot afford to have a legal director for Europe and a legal director for the US. And so most of the times I hitch the ride, and so I syndicate. It is true also that because of the size of the assets under management in the fund, I typically don't lead, so I syndicate. But it is true that I tend to syndicate, as you were saying, with strategics and people that are like-minded. And to that end, I'd like to think that what we bring to the table to most of our US portfolio companies is the fact that we own 35 hospitals in Europe, and we own a pharmaceutical company based in Europe. So if you're developing that, I constantly have that access and can open doors in that regard, right? So it's not just about the money, it's about the operations and raising that kid. I fully agree with that. You said earlier about the LPs and the funds having to raise the next fund and doing their annual meeting at the Four Seasons or the Sheraton. I think that's very true. I think that the fact that these are maybe Gen 2, Gen 3 of families that have built big businesses and made big exits have this mentality of very strict financial discipline in how they operate, because they learned that scaling their businesses, and now that's how they run their family offices, and so that's what it's expected of us as managers too, and that's why some of us here have operational experience, I think.
By the way, you touched on something I think that's really important, and I wasn't aware of it until I was in kind of this part of the world, which is, it's, I think, very different if you're, you know, and I use these terms, I think funny, but a G1, a G2, a G3 situation. In my case, it's the founder. He made the money, and he views himself as an operator, and he's doing this because this is how he wants to spend his time, and that changes the flavor of how we as an investor operate versus, you know, if you're the third generation, you know, it's just going to be a different circumstance. So it's an actually interesting thing. And if you're a company and you're talking to a family office, going back to one of our earlier points, it is important, if you want to understand the psychology of selling to that group to get money out of them, to understand what stage of life cycle that family office is in. Because I think generically it's going to be very different if it's G1, G2, G3, G4.
So we talked about timelines, flexibility, wiggle room. Sometimes it's a paradox, and I'm not talking about late-stage growth institutional venture capital that can, you know, jump in semi-late, take the 2 to 5 year ride. But I'm talking about those entrepreneurs who are looking to raise from institutional venture capital for Series A. And then sometimes it's a bit of a paradox because those institutional venture capitalists are usually running on that 10-year horizon. If it's a class 3 implantable device, we all know that story. It's going to take quite some time. Maybe a little bit of a confrontational topic, but is MedTech venture backable, and is family office and our family offices the ideal form of capital for taking that long-term journey with a company?
The advantage is that you don't have an ending fund, right? So it's not that you have a horizon of 4 years of investing and then 3 years to exit the companies. If you manage to find in a family office a co-conspirator, someone who really believes in your mission, I'm saying this as a founder, then the family office can be a blessing, because no one's sitting with a stopwatch and waiting and saying, yeah, we have to exit now because we're going to go on to the next fund, et cetera, et cetera. So from that perspective, it is actually sort of an evergreen experience. So if you find the right office, but I've also seen some family offices that have been very, very hard about the timelines. When you didn't live up to this, and this doesn't work for us, and then they come and break your caps, right? So, but if you find the right family office and you manage to communicate clearly that this may be a long journey, this may even be a very long journey, and they say, yeah, we know what we're getting into. We know it takes time to build a business. We know it takes a long time to build a business. It may actually be much, much better than VC, who may at one point start to push you towards a too early exit. And we've seen that a lot in Israel. You've seen all of these exits that had they just gone on another 2 years, they would have generated, instead of 4x on the money, they would have done 1,000x on the money. So I think this is something you should think about, especially in MedTech, because we know it's very hard to get to a significant exit within the time of a regular venture capital fund, which will be maximum 7 years.
But Dan, I think you can pin this to MedTech exclusively. I mean, you and I have involved, you know, digital health, for instance, where business model is not yet proven. It's actually very unstable. I mean, you may get to the market faster, but still consolidating the business usually takes much, much longer, whereas in MedTech is the development time that puts you away, and then maybe the uptake can be faster if you know how to do it and you're disciplined about it. So I wouldn't pin this to MedTech. I think it's just inherently healthcare.
Yeah, I mean, for cardiovascular medical devices, we're most frequently investing in class 3 PMA, and most frequently investing it to fund first-in-human studies. And so the most typical path for our companies is a first-in-human, and then a pilot or EFS, and then a pivotal. And cardiovascular is really one of the few therapeutic areas where you get exits before commercialization. But even then, the journey with our companies is oftentimes like 5 years at an optimistic pace. And that's optimistic, right? And things happen along the way. And so I think we are fortunate that we're able to be patient and intentionally take that early stage risk. But I think to your question, Giovanni, a lot of it is, and Dan touched on this as well, it's just aligning not who is the right, are there right investors or wrong investors, but who are the right investors for you? Is it, what story do you want to be a part of, and to make sure you have investors that align with the path that you want to take?
And again, given what I would argue is the greater diversity among this universe of investors versus traditional investors, I think it's incumbent on the founders to really understand what the expectations are, what are those issues, and you need to spend an extra, 22 minutes, figuring that out, because, we've all meet with founders, and the founders say, oh yeah, I love help, and I love this, and you'll say, because you're just trying to get money, and because you're just going to, just like we're meeting 1,000 companies, you guys are meeting 1,000 investors, and you're just trying to do what you need to do, and we're trying to do what we need to do, but there are differences. And it is incumbent on you, particularly when you're talking to this investor base, to spend a little bit of extra time, because there are differences, and it will make your life much better and our life much better if the match is actually a better match. So I'd really encourage people to not just give that mouth service, but lip service, but to really think through that and push people to explain what it is that motivates that organization.
And in the sample set that we have here of family offices, one major takeaway that I'm taking away is that each family office is truly unique. And like you said, get to know that family office, get to understand their motivations. And yes, you can categorize them as a family office, which may be easier for the entrepreneurs trying to hunt down that particular profile of investor. But once you lift up the hood, it's very different. They have to do that extra work to figure out how they ultimately work with you. That's my takeaway. So I hope everyone learned a little bit more about family offices here today. Please give a round of applause to the family offices here on the stage. Thank you so much.